Hey, everybody, welcome to our COVID-19 market. It's always a thrill. What can I say? Let's dive right in for March 30th to 2020 for our Wall Street winners. And of course, this is kind of the COVID-19. Oh, no, I didn't say that out loud. Okay. So we got the rally up, and I think we've started to come down a bit. Now, it's a little premature. I wish I was doing this broadcast for you in 2 days rather than today. But we came down, but there's a couple of things that I need to show you. First of all, the purple predictor, that purple line there, is above the price. That shows that the smart money's buying on this dip. But if we go down to the volume, you can see that this rally occurred on very low volume. And volume is a confirming factor. So the volume did not confirm the rally. So we have conflicting factors here. Now, volume will trump smart money simply because there's more volume than there is smart money. But we really got to be paying close attention to both of these. That's why I wish I could have another day or two before putting this issue out, because I think this conflict will be resolved very soon. The Dow, you can see we got a big increase in buying pressure, but then the buying pressure started to fade. But I think the most noteworthy thing in the upper right-hand corner is selling pressure is declining. So even on Friday, when the market came down, it didn't come down because of increased selling pressure. It came from the longs, the bulls, running out of gas. So, this is, once again, I kind of put all this into the category of mildly bearish, but not significantly so. NASDAQ purple predictor is very bullish, but price action, we closed on the low of the day on Friday. So kind of conflicting indicators here. Seasonality, we're still neutral, no question about that. Once again, notice how the volume really contracted as we went through the rally. That's not bullish. That says that this was a bear market rally, not a bull market. Our seasonality should be the green line. Chop, chop, chop. All right, a dynamic yield curve here. We got up to 110 last week, and I said that that's probably not enough. I mean, it's certainly good. But if you look in the lower right-hand corner, what I'm looking for is a sharply positive curve. So that would be closer to 200. We got up to a little over 110, so that's a step in the right direction. But we were below zero for so long, for months. And we went below zero. You can see here we broke below zero 6 times. But the first one was last March. Then we were effectively below from really May until October. And then we dropped below again in February. So this is a massively bearish factor in the marketplace. VIX is going to come down. We'll see a spike up, I think, this week because I look for the market to drop this week. So we'll see it go back up, but it won't break through the highs at 82.69. We've reached the peak in VIX in this bear market. Asset allocation, we got a little bit more money back from the bond market into the stock market. Stock market risk indicator, all of a sudden they got frisky, and then at the end of the week they said, I'm not that frisky. Global shares, looks like the U.S. market, nothing to say here. Bonds have started to rally again. Purple predictor, very bullish. I'm looking for bonds to break to new highs. I don't feel like trading them because look at the volatility we've had here. But the purple predictor is bullish. And here's why I think bonds are going to new highs. The government has enforced a depression onto the United States. Not a recession anymore. I think we're headed for a depression. So what's now expected is that most economists are looking for a 10% decline in GDP in the first quarter. Now, that's a remarkable number because remember, 2 of the 3 months, we didn't have a quarantine. Everybody didn't have to stay home. So the government wasn't destroying the economy for the first 2 months. It was only the third month. So when you average it all out and you say, well, then the total 3 months was down 10%, that means that the third month must have been down like 20% in order to get the math to work. But that same negativity, that 20%, that's depression level. That's going to carry into April. Now, of course, we don't know how long the enforced quarantine is going to be. We don't know how long the government's going to decide that they're going to uphold a depression in order to counteract COVID-19. We don't know that yet. The president had said, hey, let's try to get out of here by April. He says he'd like that. Well, we'd all like that. We'd all like it tomorrow. But I'm not feeling that Andrew Cuomo or the governor of the state of Washington, I'm not feeling that these guys want to give up this quarantine before the end of April. So that would mean another month of at least 20% decline. Now, the key here is with 20% decline, then bonds will rally dramatically. Dramatically. We're going to see those 180 highs broken. We're heading maybe to 200 on the bonds, which is insane price levels. We're going to 0% interest on the 10-year treasuries, okay? This is a chart of the 20 years. They won't get to zero soon, but the 10 years will get to zero probably by May, sometime in the month of April, because we're going into a depression. The problem, of course, is that if the U.S. is in a depression, then the whole world is in a depression. As they say, when the U.S. catches a cold, everybody else gets pneumonia. So this chart is telling us that. Bond key factors also telling us that. Dollar. What's happened here is I told you a week ago that the dollar was up very, very strong because there's a massive shortage of dollars around the world. And so what happened in the last week is the Fed came out and said, well, we're going to basically ease monetary policy by $4 trillion, of which hundreds of billions, maybe $1 trillion of that is going into what are called dollar swaps. And dollar swaps are where the Fed basically calls up central banks. Hey, European Central Bank. Hey, Bank of Japan. Hey, Bank of Canada. Hey, Bank of England. How many dollars would you like? We got the printing presses going like crazy. And you know what? Since we only have to print electrons, we can pass over some of these electrons. How many do you want? And so they're basically handing out helicopter money to other central banks. So they're flooding the world with dollars. And that's why we saw the big reversal here. And the dollar is now under severe pressure. Now that helps emerging markets because their debt would be onerous if it stayed in strong dollars. So this is helping out a lot of foreign countries by having a weak dollar. Now, this was a fantastic looking chart. So as the Fed's massively easing, the price of gold skyrockets. Now we got up to the level 2 times we've been up in the $1,690, $1,700 range. And as I've been telling you, the early part of a bear market, we really see the gold market come under pressure as people sell it in order to get cash to pay their margin calls. I think that the Fed has said, don't worry about it. We're going to flood the economy. And by the way, I don't know if you guys know this or not, but most of the stimulus money is going to Wall Street. 2/3 of it is going to Wall Street to support mortgages. I mean, it's like, wait a minute, what? It's going to Wall Street? I'm sorry, but I think most people, citizens are suffering. If Wall Street have some defaults, well, the hell with them. That'll teach them to make bad mistakes. But anyway, but the rest of us, we don't have a job because the government tells us we're not allowed to have a job right now. But Wall Street, they can, I don't know, I'm very disturbed with that. But nonetheless, here we go. So with this flood of money, this is the opposite of the dollar chart. This money, the market is saying is going to be very, very inflationary. Now, I don't want to buy gold until it breaks those 1,700 and change highs. But boy, we're getting closer and closer and closer. Our indicators turned to 2 out of 3 are now bullish. And that's a big change from basically 2 weeks ago when all 3 were negative. This is a big turnaround, and it's all caused by Fed easing. West Texas, this was interesting to me because you can see there, we basically went down and made the second lowest close in years. I told you last week that I'm looking for 10 or $15 as the low, somewhere in that range. That'll put out all the American frackers, tight oil, shale oil, whatever you want to call it. They're all out of business. We will see massive bankruptcies in Texas, South Dakota, North Dakota. You know what I'm talking about. All of those places. We're going to see the economy of places like Pennsylvania get killed because they had expanded and had such a strong economy on the back of fracking. Now the fracking's gone and they have COVID-19. So look for Pennsylvania to be hit particularly hard going forward. So, you know, with the economy in a depression, with a price war between Russia and Saudi Arabia, the only way this starts to get back into a bull market is we got to get out of the COVID-19 quarantine, and we've got to stop the price war between Saudi Arabia and the Russians. Now, that's two things have to happen. Well, tomorrow, none of those are going to happen. So this is still under pressure, going lower. And Bitcoin, we've decided, the universe has decided that it's not a safe haven. And that, you know what, we really need to get the Bitcoin back into dollars because we're short on dollars. I get these Bitcoins, that's great, but I can't buy anything. I go down to my supermarket and I can't buy toilet paper with Bitcoin. I need dollars. So I'm dumping this crypto and I'm going back to folding money or gold. You'll notice that. The other thing is, notice the purple predictor has turned bearish. So look for this to go back and challenge and probably break the lows at 39.25. This is actually probably a good opportunity to short sell Bitcoin at this point. All right, a lot happening, freebies. Love having you here. You know that. But fully paid up members, hang on just a minute and we'll get to you. Now, freebies. You've got to get this course, okay? I keep telling you, but I mean, it's like, look, go to bit.ly/how to make money bear market, okay? Go there now and buy the course. You cannot afford to not have the course. It's a few $100. What's your future worth to you? We're about to start the second leg of this bear market. We're going to go to 1,600. You've got to get this course in order to protect your family, protect your wealth, and, in fact, make a lot of money. All right, freebies. We'll see you next week.